Welcome to the secret world of finance. Today, we're zeroing in on a financial cornerstone, emergency funds. We all know life throws curveballs: a sudden car repair, an unexpected medical bill, or even a job loss. And these moments can turn our financial world upside down without a safety net.
Yeah, and that's exactly why this topic is so critical. The numbers speak volumes here. You might find it surprising, but 59% of Americans would genuinely struggle to cover even a $1,000 emergency expense using their savings.
Wow, 59%.
Yeah, and a significant 27% report having absolutely no emergency savings at all. This isn't just about covering a bill, it's about financial resilience, really.
Those statistics paint a pretty vivid picture of vulnerability for so many. Our goal today is to, well, unravel the fundamental principles of emergency funds. We'll explore what truly qualifies as an emergency, get into why this financial cushion is so profoundly important, beyond just the obvious, how you can accurately size your own fund, and crucially, the smartest places to keep your money so it's both safe and, accessible when you need it most.
Right. And we'll also break down practical, actionable strategies for building your fund, highlight common missteps people make, and even touch on the fascinating psychology behind why saving can feel so challenging sometimes. By the end of this discussion, you'll have a clear roadmap, basically, to build and maintain an effective emergency fund, helping you navigate life's inevitable surprises with far greater confidence and peace of mind.
Okay, so let's start right at the beginning then. What exactly are we talking about when we say a true emergency for this fund? I mean, in a world where every want can feel like an urgent need, how do we draw that line?
That's a crucial distinction. A true emergency, well, it has three key characteristics. It's unexpected, it's urgent, and it's essential. It's an expense that you really can't postpone or avoid without significant negative consequences.
Unexpected, urgent, essential.
Okay. Think of it this way. A sudden, unforeseen expense that's critical to your health, safety, or your ability to earn income. For instance, medical emergencies, like an accident or a sudden illness not fully covered by insurance, they can quickly become substantial. Healthcare costs, actually, are a major component of typical emergency fund recommendations. We're talking thousands sometimes.
Right, those deductibles and out-of-pocket costs can be huge.
Exactly. Then there's job loss or significant income disruption. Without that steady paycheck, you obviously need savings to cover basic living expenses during the transition. Major home repairs like a collapsed roof or a burst pipe, those can cost thousands and simply can't wait.
Yeah, you can't exactly ignore a hole in your roof.
Not really, no. Same goes for essential vehicle repairs, especially if your car is crucial for work or, daily life. And finally, unexpected family emergencies like urgent travel for a funeral or a critical family situation often arise with very little warning.
That breakdown really clarifies the need side. But like you touched on, it's easy to rationalize spending, isn't it? What are some of the most common misdirections our brains throw at us? Things that feel like an emergency but aren't really what this fund is for.
It's a common pitfall for sure. People often blur the lines between a true emergency and something that's, well, a desire or even a foreseeable expense. Things like vacation expenses, holiday shopping, routine maintenance for your home or car, which you should ideally be budgeting for separately.
Ah, so things you can plan for.
Exactly. Those aren't emergencies. Discretionary purchases, exciting new investment opportunities, or, lifestyle upgrades, not emergencies for this fund. Dipping into your emergency savings for these types of things fundamentally undermines its purpose. It leaves you vulnerable when a real crisis hits. It's about discipline, really, and clear boundaries.
Okay, so it sounds like an emergency fund isn't just about covering a bill. It's more about building a robust financial ecosystem that safeguards your entire future. Beyond avoiding debt and reducing immediate stress, how does having this buffer actually empower you? Maybe to take opportunities or make better long-term choices?
That's a great way to put it. It's your crucial buffer against major financial shocks.
Ah,
Without it, people often resort to high-interest debt.
like credit cards.
Exactly, which can spiral really quickly. Or they're forced to compromise their long-term financial goals, sometimes irreversibly. I mean, consider this. Research shows households with at least $1,000 in emergency savings were half as likely to withdraw from workplace retirement savings during the COVID-19 pandemic.
Wow, half as likely. That's a direct link to protecting your future then.
Absolutely. It prevents that painful choice of raiding your retirement nest egg.
So what about the more immediate sort of day-to-day impact on our well-being?
Oh, the psychological benefits are immense and often underestimated, I think. Financial stress is consistently ranked as a top source of anxiety for Americans. Something like 65% of adults identify money as a significant source of stress.
65%? That's huge.
It is. And having an emergency fund provides deep psychological safety. It reduces that nagging background anxiety about potential financial disasters, letting you breathe easier. Studies actually demonstrate that individuals without an emergency fund reported stress scores nearly 9 points higher than those with savings.
9 points higher.
Yeah, it truly provides a sense of calm. It lets you focus on thriving, not just surviving.
It really allows you to reclaim that mental bandwidth, and that peace of mind, presumably, helps protect those bigger financial dreams,
Right.
like saving for a home or maybe pursuing a new career path.
Absolutely. If we connect this to the bigger picture without adequate emergency savings, unexpected expenses can force really difficult choices. You might withdraw from retirement accounts early, incurring penalties and taxes. You might interrupt your consistent investment contributions.
Which hurts compounding.
Right. Or you might even be forced to liquidate investments at really bad times, like selling stocks when the market is down, just locking in a loss. It also pushes people into accumulating high-interest debt that can take years to pay off. So yeah, an emergency fund is a protective barrier for your financial future. It prevents that ripple effect of negative consequences.
Okay, given how absolutely critical this buffer is, the next question has to be, how much money are we actually talking about? We often hear 3 to 6 months of expenses, but is that truly the right number for everyone? It sounds a bit generic.
It's a good starting point, definitely, but you're right. The right number is highly individualized. The core calculation is straightforward enough. It's your monthly essential expenses multiplied by your target months.
Monthly essential expenses.
Exactly, essential. These are the absolute non-negotiables. Housing, food, transportation, insurance premiums, minimum debt payments, healthcare costs, basic personal care. This isn't your fun money. It's what you need to simply keep the lights on and yourself afloat, basically.
So the target months part is where the nuance really comes in then. What factors influence whether someone should aim for, say, 3 months or maybe closer to 12?
Right. This gets into your individual risk and stability. For example, if you have very secure employment in a high-demand field, maybe 3-4 months might be enough coverage. But if your income is variable, say you're a freelancer or work on commission, or your job security feels lower, then aiming for 6-12 months is much more prudent.
That makes sense.
Yeah.
More uncertainty means a bigger cushion.
Precisely. Family responsibilities play a big role too. A single person typically has fewer essential expenses than a family with kids. Industry volatility matters. Workers in cyclical or freelance roles, yeah, they should target a larger fund. Less predictable income, often fewer traditional benefits. And lastly, health considerations. If you or a family member have chronic conditions or higher medical risks, a larger fund is just wise. Covers potential healthcare costs, deductibles, all that.
Can you give some specific examples, maybe for different life stages or situations, so listeners can kind of picture where they might fit?
Sure. For gig economy workers, like we mentioned, 6-12 months of expenses is highly recommended. That income variability is key. Dual income households, well, they might target 3-6 months, but it's really vital to assess if both income sources could be affected at the same time.
Like if they work in the same industry.
Exactly. That increases the risk. Single income households, on the other hand, carry a higher risk of total income loss, so they should probably aim for 6-9 months. And for retirees, a fund of 6-12 months of expenses is often suggested. They might have higher healthcare costs and obviously limited income replacement options since they aren't earning a regular paycheck anymore.
Okay, that's really helpful context. So once you figured out your target and started saving, where should you actually keep this crucial money? Is stashing it in your regular checking account good enough? Or, the old mattress method?
Absolutely not to the mattress, and definitely not just in a checking account. The absolute core principle here is liquidity. That's the key word. Your funds must be easily accessible when needed, ideally within 1-2 business days, with 0 penalties for withdrawal. And critically, they must be protected by FDIC or NCUA insurance.
Right, the government insurance. Up to $250,000 usually.
Exactly. That guarantees its safety. Earning some interest is nice, a bonus, but it's absolutely secondary to safety and immediate access.
So for listeners looking for the best places that tick all those boxes, safe, liquid, insured, what are your top recommendations?
High-yield savings accounts are usually optimal. You often find the best ones at online banks or credit unions. These accounts offer significantly higher annual percentage yields, or APYs, than your traditional brick-and-mortar savings accounts. While rates fluctuate, many competitive online options currently offer APYs somewhere in the 4 or 5% range. It helps your money grow a little without sacrificing access or safety.
So at least keeps up a bit with inflation, maybe.
Hopefully, yeah. Money market accounts also provide competitive rates and excellent liquidity, so they're another strong contender.
And just as important, what should we definitely avoid for this critical fund, even if they seem tempting for higher returns elsewhere?
Right, you absolutely must avoid certain vehicles, traditional checking accounts, minimal interest, and they just encourage spending.
Yeah.
Too easy to dip into. Certificates of deposit or CDs. Big no-no. They penalize you for early withdrawal, which completely defeats the purpose of immediate
Because
access.
the CDs are out.
Definitely out. Investment accounts like stocks, bonds, mutual funds, far too risky. They can lose value precisely when you need the money most. Market downturns often happen alongside job losses.
Like whammy.
Exactly. And of course, cryptocurrency, its extreme volatility makes it totally unsuitable for emergency fund storage. The goal here is preservation and access, not high-risk growth. Period.
Okay. Now, saving a significant amount of money, maybe 6 months of expenses, can feel incredibly daunting, like looking at a huge mountain.
Mm.
How do you suggest people approach it to make it feel less overwhelming? How do you even start?
Yeah, it can feel like that. It's best to use a graduated building strategy. Take it one step at a time. Phase one is your starter fund. Aim for a modest goal, like $1,000 or maybe $2,000.
Just get something in place quickly.
Exactly. It provides basic protection and, maybe more importantly, helps you establish the saving habit. It's a quick win. Research even shows that having just $2,000 in emergency savings can boost your overall financial well-being by a significant 21%.
Wow, just $2,000 makes that much difference.
It does. Phase two is the essential fund. Expand your savings to cover 1-2 months of expenses. That gives you a more robust cushion. Then phase three is the complete fund, where you diligently build towards your full recommended amount, whatever that number is for you.
That phased approach definitely makes it sound much more achievable. But consistency can be the biggest challenge, right?
Yeah.
Sticking with it month after month.
Absolutely. And automation is truly the secret weapon here. It takes the decision-making burden off your shoulders and ensures consistent progress.
Set it and forget it.
Pretty much. You can set up payroll deductions, have a portion go straight to your emergency fund before you even see it in checking, or set up automatic transfers from checking to savings right after payday. Some banks even offer those round-up programs. They round up your debit card purchases and zap the difference into savings. You save passively without thinking.
Those are brilliant for consistency. Now, for listeners looking to maybe accelerate their savings, especially in the beginning, any tips for finding extra cash to funnel into the fund, even temporarily?
Oh, sure. Start with a temporary spending freeze or just a really honest budget review. See where you can cut back on discretionary stuff.
Like maybe fewer coffees out or pausing a streaming service.
Exactly. Even small changes add up. Direct any unexpected windfalls like a tax refund or a work bonus straight to the fund. Don't even let it hit your checking. You could also consider a temporary side income, a side hustle, specifically just to build up your emergency savings faster. The key is being really intentional with any extra money you find.
Right. Give every dollar a job, and that job is building the fund.
That's the idea.
So, what are the most common pitfalls people encounter, either when building the fund or maybe more critically, when using it? What are the big red flags?
Oh, there are several, and they can be very costly mistakes. Mistake number one is just inadequate fund size. People often underestimate their actual needs. They forget things like paying for health insurance premiums if they lose their job, or maybe higher utility costs if they're home more.
Good point. Little things add up.
They do. Second is inappropriate investment choices. We touched on this, but putting emergency funds in volatile assets is a huge gamble you just can't afford to lose. Think back to 2008. Investment losses happened right alongside job losses. Funds weren't there when people desperately needed them.
Nightmare scenario.
Truly. Third, using the fund for non-emergencies. Treating it like a bonus savings account for vacations or holiday shopping completely defeats its purpose. Discipline again. Fourth, failing to replenish it after using it for a legitimate emergency. You use it, great, that's what it's for, but then you have to prioritize building it back up or you're just as vulnerable again.
Back to square one.
Or worse. And finally, all or nothing thinking. Waiting until you think you can save the full amount before you even start. That often means you never actually begin at all. Starting small is key.
It sounds like there's some significant mental barriers, too. Our brains can play tricks on us even when we know logically what we should be doing. What are those hurdles?
Oh, yeah, absolutely. Behavioral finance talks a lot about this. One big one is present bias. We're wired to prioritize immediate rewards over future benefits. That new gadget today feels much more real than some theoretical emergency months or years down the road.
Instant gratification wins.
Often, yes. Another is optimism bias. We tend to underestimate our own likelihood of experiencing bad stuff. That won't happen to me. And then there are just competing priorities. Other financial goals, like investing for retirement or saving for a down payment, often feel more urgent or more rewarding because they represent growth, not just protection.
So, knowing our brains are kind of wired this way, how do we outsmart ourselves? Are there specific behavioral tricks or strategies we can use?
Yeah, there are definitely ways to nudge ourselves in the right direction. First, mentally frame your emergency fund as separate, untouchable. Maybe even give the account a specific name like Life Happens Fund or something. It's not your money for everyday stuff.
Make it psychologically distinct.
Exactly. Second, leverage visual progress tracking. Use charts, apps, even a simple thermometer graphic on the fridge. Seeing that number grow can be incredibly motivating.
Gamify it a bit.
Sort of. Third, celebrate milestones. Hit $1,000. Great. Reached your first month of expenses. Acknowledge it. It keeps momentum going. And like we said, rely heavily on automatic systems. Automation removes the daily decision making, which is where our willpower often fails us.
Okay, this is a big one for many listeners. The classic dilemma. Should I save for emergencies or should I pay off debt first? It feels like a constant tug of war.
It really does, and it requires careful consideration because there isn't one single right answer for everyone. For high-interest debt, think credit card debt, often with rates above 15%, 20%, even prioritizing aggressive repayment after you have a small starter emergency fund usually makes financial sense.
Because that interest is just eating you alive.
Yeah, precisely. It can rapidly erode any progress you make elsewhere. However, for low-interest debt, like mortgages or most student loans, you can typically keep making the minimum payments while you focus on building up your full emergency fund. Your job security also plays a role here. If your job feels very stable, you might lean towards more aggressive debt repayment. If your income is variable, that emergency fund should probably be the higher priority.
So what's the balanced approach that many financial experts recommend? Is there a sort of standard playbook for tackling both?
There's a generally recommended sequence, yeah. A balanced approach often looks like this. Step 1, build that starter emergency fund. Get $1,200 or $2,000 set aside quickly. That's your immediate buffer.
Okay, step one, small buffer.
Step 2, aggressively pay off all your high-interest debt. Attack those credit cards, personal loans, anything with a really high rate. Get rid of them.
Wipe out the expensive debt.
Step 3, once that high-interest debt is gone, then focus on building your complete emergency fund to your full target amount, 3, 6, 12 months, whatever you determined.
Build the full cushion.
Right. And finally, step 4. Once your emergency fund is fully established and secure, then you can resume more aggressive repayment on any remaining lower interest debt and really ramp up other long-term goals like investing.
That sequence makes a lot of sense. Buffer first, then attack high-cost debt, then build the full buffer, then focus elsewhere.
Exactly. It balances immediate safety with tackling the most damaging debt.
Sometimes the best way to really grasp the power of something like this is to hear how it's actually worked for real people. Do you have any examples? Stories that illustrate the impact?
I do, and these stories really drive home the value of preparation. Take Sarah, a freelance graphic designer. She was diligent, built up a 9-month emergency fund over several years. When the COVID-19 pandemic hit and her client work dropped by like 60%, that fund wasn't just money, it was a lifeline.
Wow, 9 months. That's impressive for a freelancer.
It took dedication, but it allowed her to keep her apartment, cover her health care, even invest in new skills to pivot her business, all without taking on a single dollar of debt. She came out stronger.
That's huge.
Yeah.
Saved her business, probably.
Quite possibly. Another example, the Johnson family. They had good health insurance, but they'd wisely built a 6-month emergency fund. When their daughter needed emergency surgery and significant rehabilitation afterwards, the fund covered $15,000 in out-of-pocket costs.
$15,000, even with good insurance.
Yeah, and it even allowed one parent to take unpaid leave from work to focus on caregiving. This preparation prevented them from falling into potentially ruinous medical debt.
Which happens to so many families.
Sadly, yes.
Yeah.
And one more. Mike, a marketing manager, he had saved up 8 months of expenses. When his company had significant layoffs, his fund gave him incredible freedom. He didn't have to panic and take the first job offer. He could conduct a thorough, patient job search.
So he could be strategic, not desperate.
Exactly. And it paid off. He ended up landing a better job with higher pay. It shows how these funds can actually be an investment in your future self and your career trajectory.
Those stories really bring it home. Okay, let's tackle some common misconceptions. What are those persistent myths you hear that keep people from building these funds? Things that need debunking.
Oh, there are definitely a few that hang around. Myth number one: I have credit cards for emergencies.
Ah, the credit card crutch.
Exactly. It's incredibly dangerous thinking. Credit cards have high interest rates. Your credit limit might get cut during an economic downturn just when you need it. And some essential costs, like maybe your rent or mortgage, you often can't even pay with a card. They are a debt trap, not a safety net.
Okay, myth busted. What's another one?
Myth number two: I can just invest the money and get better returns. We've sort of covered this, but it bears repeating. Investing emergency funds completely defeats their purpose. Safety and liquidity are paramount. Investments can lose value exactly when you need the money most. Market downturns often coincide with job losses. You're forced to sell low. It's the opposite of what you need.
Right. Preservation, not growth, is the goal here.
Precisely. And myth number three: I'll just borrow from my 401k, your workplace retirement plan. While it might seem easy, 401k loans seriously compromise your long-term financial security. They reduce your retirement savings growth because that money isn't invested. Plus, if you lose your job, you might have to repay the loan immediately, which is often impossible. And if you default, it becomes a taxable distribution with penalties. You're damaging your future self.
So borrowing from your future retirement isn't a real solution.
Not for an emergency fund, no. It creates more problems than it solves.
So putting it all together, it's clear an emergency fund isn't just this standalone pot of money sitting off to the side. It really integrates into a bigger financial picture, doesn't it?
Exactly. It's truly the foundation for almost every other financial goal. It prevents those premature retirement account withdrawals we talked about, protecting your long-term wealth. It actually allows for more aggressive investment strategies elsewhere in your portfolio because you know your core safety net is secure. You can take appropriate risks with your long-term money.
Because your short term is covered.
Right. It also acts as a critical complement to your insurance policies. It covers deductibles, co-pays, anything insurance doesn't fully handle. And building overall financial resilience goes beyond just the fund itself. It involves things like maybe cultivating multiple income streams, continuously developing new skills, building a strong network, prioritizing your health. It's an ecosystem of preparedness. In this uncertain world, an emergency fund, well, it's truly more than just money in the bank. It's your financial independence, your peace of mind, really, and your ultimate protection against life's inevitable surprises.
Those statistics we started with, about Americans struggling with even small emergencies, they're a stark reminder, aren't they? But they also highlight this incredible opportunity for you, our listener, to be among the financially prepared. The journey to building this fund, well, it requires patience, discipline, and some strategic thinking.
Absolutely. Remember the graduated approach. Start small, make it achievable. Automate your savings, take the decision-making burden off yourself, and just gradually build toward your target amount. Remember, even modest emergency savings provide significant benefits. Like that statistic, just $2,000 can boost financial well-being by 21%. It truly makes a tangible difference in reducing stress.
Your emergency fund isn't just about weathering storms. It's really about creating the financial foundation that allows you to pursue opportunities, take calculated risks when appropriate, and build long-term wealth. It's the difference between financial survival and, well, financial thriving. In a world where emergencies are not a matter of if, but pretty much when, your emergency fund stands as maybe your most important financial tool.
Yeah, I'd agree with that. The path to genuine financial security, it really begins with that single step, starting your emergency fund today. Whether you begin with $25 or $250, the important thing is just to start. Commit to the process. Your future self will undoubtedly thank you for having the foresight to build this crucial financial safety net.
Thank you for listening. See you again in the next episode.